Welcome back to another update, and thank you for joining me. As always, I give away $10 of XRP daily on the channel. To enter the giveaway, just like the video, subscribe with notifications on, and leave a comment in the YouTube comments below. Hold on to your seats, folks, because the Ripple SEC saga just got even more heated. The regulator is facing mounting criticism, with even its staunchest defenders now questioning its position. Pro-Ripple lawyer John Deaton has once again slammed the SEC's arguments, calling them stupidly outrageous in a tweet posted on February 19th. He was specifically taking aim at the SEC's claim that anyone who buys XRP in Japan is part of a common enterprise with Ripple and all other XRP holders, and that the token is a security. This is despite Japan's own regulator, the Financial Services Agency, saying that XRP is not a security. But Deaton wasn't done there. He also stated that if the SEC were only going after Ripple's sales of XRP, he would have never filed a suit against them. Ripple's offers and sales of XRP may have violated U.S. securities laws, and if the SEC were only pursuing Ripple's sales, I would have never filed suit against the SEC, he said. This is important because Deaton had previously said that the only win the SEC would likely get in the case is that Ripple sold XRP as a security between 2013 and 2017. As a reminder, the SEC is suing Ripple for the sale of unregistered securities in the form of XRP tokens. Ripple's chief legal officer, Stuart Alderati, has also joined the fray, suggesting in a tweet on February 19th that the SEC might be overstepping its mandate. He argued that observing the rule of law is necessary to prevent government agencies from overstepping their legal authority and becoming autocratic. To the extent that the mere will of an agency official or an agency itself is permitted to exceed the authority granted by law, the government becomes an autocracy. Against this threat of officialdom unchained, the courts have always been vigilant. Jones v. SEC, 1936, he said. Meanwhile, the lawsuit is also seeing renewed interest in unsealing certain documents. A senior contributor to Forbes, Rosalind Layton, filed a motion to gain access to the Hinman speech documents. The Hinman speech, given by the former director of the SEC's Division of Corporation Finance in June 2018, is an important document in the Ripple case because it is believed to contain the regulator's position on how cryptocurrencies are classified as securities. Ripple's legal team has been seeking to obtain the documents for review, as they believe that the inferences made in the speech about Bitcoin and Ethereum could also apply to XRP. If you still haven't pressed the like button, go ahead and we'll smith the heck out of that button because I have a lot more information I discovered today. As the SEC fights to keep the document from the public, Deaton had initially pointed out that they will eventually be unsealed ahead of the speculated March summary judgment. As the legal battle enters its third year, investors are closely watching the overall implications of the ruling on the crypto sector. XRP, in particular, is among the assets to watch since it has previously traded in tandem with the case's critical decisions. The tension continues to rise, with both sides digging their heels in. Who will come out on top in this high-stakes legal battle? Only time will tell. Really quick, if you guys want $40 guaranteed for free, sign up with Webull Deposit, just a penny, and you can get up to $3,000 in free stocks. Typically, you get $40 to $300, but it's a great offer just for signing up and depositing a penny. You are guaranteed a minimum stock value of $40. Sell your stocks, close your account, do whatever you want, but don't miss out on this awesome promo. It does end soon. The link for your free stocks in the video description below. But one thing is for sure, the Ripple SEC case is far from over. Federal Reserve Chairman Powell's recent statements have been making waves in both traditional and digital asset markets. At a recent event, Powell addressed questions about the Federal Reserve's recent decision to raise interest rates by 25 basis points, citing a need to bring down inflation in the goods sector. However, Powell also noted that the process of disinflation will be a bumpy road and will likely take a significant period of time. This sentiment was reinforced by the unexpected strength of the labor market report for January, which showed that the economy added 519,000 jobs. Investors in both traditional and digital asset markets have been closely watching these developments, with many wondering what this means for the future of interest rates and inflation. While the markets had initially assumed that the Federal Reserve might consider decreasing rates by the end of the year, Powell's recent comments suggest that ongoing rate increases will be necessary to achieve a stance of policy that is sufficiently restrictive to bring inflation down to 2% over time.
But at the time, it wasn't clear that the jobs report would be as strong as it turned out to be subsequently. Had you known that the jobs report was going to be as strong, would you have done 25 basis points or something different?
David, thank you for that question, and thank you for inviting me here today. It's great to be here. So we don't get to play it that way, unfortunately. We have to, but I'll take it this way. So the message we were sending at the FOMC meeting last Wednesday was really that the disinflationary process, the process of getting inflation down, has begun, and it's begun in the goods sector, which is about a quarter of our economy. But it has a long way to go. These are the very early stages of disinflation. So the services sector, really, except for housing services, pardon me, is not really showing any disinflation yet. So our message really was this process is likely to take quite a bit of time. It's not going to be, we don't think, smooth. It's probably going to be bumpy. And so we think that we're going to need to do further rate increases, as we said, and we think that we'll need to hold policy at a restrictive level for a period of time. Then comes the labor market report for January. And it's very strong. It's certainly stronger than anyone I know expected. And so, but I would say, we didn't expect it to be this strong, but I would say it kind of shows you why we think that this will be a process that takes a significant period of time. The labor market's extraordinarily strong. And by the way, it's a good thing that inflation has started to come down without it. That has not happened at the cost of strong labor. So, and of course, since then, financial conditions have tightened significantly since then.
So let me ask it another way. So, by the way, when the numbers coming out, the jobs numbers, 519,000 jobs, does anybody call you up in the government and give you a little heads up, this is going to happen, or they never do that?
So on some data, sometimes we get data just the night before, and it's only me, and but not on all pieces of data. It's a very small amount of data, and we get it just the night before. For example, if we were going to get a big piece of data in the middle of an FOMC meeting, as often happens on the day of an FOMC meeting, it will help me to know it the night before.
Okay, so the markets, after your speech last week, the markets assumed that therefore there would probably be another 25 basis point increase in your next FOMC meeting. Was that a bad assumption by the markets?
So what we said at the meeting was that we believe that we anticipate, is what we said, that ongoing rate increases will be appropriate. And the reason is we're trying to achieve a stance of policy that is sufficiently restrictive to bring inflation down to 2% over time. And we don't think we've achieved that yet. So we said that, and now you see the labor market report, and I think, again, financial conditions are more well aligned with that than they were before.
So the assumption when you made your speech was that probably the Fed might even consider decreasing rates by the end of this year, and the markets no longer assume that. You think the markets are wrong?
Well, so let me say, these are all of these numbers that we're throwing around here are conditional on incoming data and what happens. So we never say this is what we think will happen. We make a tentative forecast and then we let the data come in. For example, if the data were to continue to come in stronger than we expect, and we were to conclude that we needed to raise rates more than is priced into the markets or than we wrote down at our last group of forecasts in December, then we would certainly do that. We would certainly raise rates more.
Okay, so today.
As always, these numbers and forecasts are conditional on incoming data and may change as new information becomes available. However, the markets seem to be more well aligned with the Federal Reserve's stance on interest rates and inflation, and investors in both traditional and digital asset markets should continue to monitor these developments closely. The next video clip of Fed Chairman Powell, he is asked, does the U.S. even control its own inflation?
The U.S. economy is pretty much in control of its own inflation rate, or there are events outside the United States like what China is doing or the Ukraine war that are affecting inflation and make you nervous about where inflation might be going?
We have the tools, the Fed has the tools to achieve our 2% goal over time. But inflation in the United States is, of course, very closely related to things that happen here, including the balance between supply and demand. It's also affected by, for example, commodity prices that are really set on the global markets. You know, oil and many agricultural commodities are priced globally. So there are certainly, it's an integrated global economy and global markets, and we are part of that.
So you get data from all the various government agencies, but
Eye-opening. Bear markets are a challenging and difficult time for investors. Characterized by a prolonged period of declining stock prices, bear markets can be caused by a variety of factors, including economic recessions, political instability, and changes in monetary policy. However, one factor that is often associated with bear markets is a decline in earnings per share. Earnings per share, EPS, is a key financial metric that measures the profitability of a company. It is calculated by dividing a company's net income by the number of shares outstanding. A company with a high EPS is generally seen as more profitable and attractive to investors. The S&P 500 is a market index that tracks the stock performance of 500 large companies listed on U.S. stock exchanges. As such, it is often used as a benchmark for the overall performance of the U.S. stock market. When earnings per share in the S&P 500 decrease, this can be a sign of declining profitability for the companies in the index. Historical data has shown that there is a correlation between declining earnings per share in the S&P 500 and bear markets. For example, during the bear market of 2008-2009, earnings per share in the S&P 500 declined sharply, reflecting the economic turmoil of the time. There are several reasons why declining earnings per share can lead to a bear market. First, when a company's profitability decreases, this can lead to lower stock prices as investors adjust their expectations and valuations of the company. This can then have a cascading effect on the rest of the market, as investors become more risk-averse and sell off other stocks as well. Second, declining earnings per share can be a sign of broader economic problems. For example, if multiple companies in the S&P 500 are reporting lower earnings, this may be a sign of a broader economic slowdown or recession. In turn, this can lead to lower investor confidence and a bear market. Of course, it's important to note that declining earnings per share is not the only factor that can lead to a bear market. As mentioned earlier, there are many other factors that can contribute to a bear market, including changes in monetary policy, political instability, and other macroeconomic factors. In conclusion, while declining earnings per share in the S&P 500 is not a guarantee of a bear market, historical data has shown that there is a correlation between the two. As such, investors should pay close attention to the earnings reports of the companies in the S&P 500 as they can provide valuable insights, including changes in monetary policy, political instability, and other macroeconomic factors. In conclusion, while declining earnings per share in the S&P 500 is not a guarantee of a bear market, historical data has shown that there is a correlation between the two. As such, investors should pay close attention to the earnings reports of the companies in the S&P 500 as they can provide valuable insights into the broader health of the U.S. stock market. Additionally, investors should remain diversified and maintain a long-term perspective when investing, as bear markets are a normal part of the economic cycle and can present buying opportunities for patient investors. The ongoing legal battle between Ripple Labs and the U.S. Securities and Exchange Commission, SEC, has been making headlines since the SEC filed a lawsuit against Ripple in December 2020. The lawsuit alleges that Ripple conducted an unregistered securities offering by selling its XRP token to investors. Ripple has vehemently denied the allegations, and the case is still ongoing. Recently, the head lawyer for Ripple, Stuart Alderoty, tweeted that the SEC has lost 4 out of its last 5 cases in the Supreme Court. This is an intriguing development that could have significant implications for the Ripple versus SEC lawsuit, the SEC's track record in the Supreme Court. To understand the significance of this statement, we must first take a closer look at the SEC's recent track record in the Supreme Court. The SEC is a federal agency that is responsible for enforcing securities laws in the United States. It has the power to bring enforcement actions against individuals and companies that violate these laws. In recent years, the SEC has been challenged in the Supreme Court on a number of occasions. In 4 out of the 5 cases that Alderodi referenced, the Supreme Court ruled against the SEC. These cases include Kokesh versus the Securities and Exchange Commission in 2017 determined the Supreme Court had the right to rule that the SEC's ability to seek disgorgement is subject to a 5-year statute of limitations. Digital Realty Trust, Inc. versus the Securities and Exchange Commission in 2018 had an outcome where the Supreme Court ruled that the anti-retaliation provisions of the Dodd-Frank Act do not protect individuals who only report violations internally rather than to the SEC. Lucia versus the Securities and Exchange Commission in 2018 ended with the Supreme Court holding that the SEC's administrative law judges are officers of the United States who must be appointed in accordance with the Appointments Clause of the U.S. Constitution. Liu versus the Securities and Exchange Commission in 2020 resolved when the Supreme Court ruled that the SEC has the authority to seek disgorgement as a remedy for securities law violations, but that the remedy must be limited to the wrongdoer's net profits and be used for the benefit of victims. So what does this mean for the Ripple versus SEC lawsuit? The fact that the SEC has lost 4 out of its last 5 cases in the Supreme Court is certainly noteworthy. It suggests that the agency's legal positions have been scrutinized and found wanting by the highest court in the land. However, it is important to note that the outcome of these cases does not necessarily predict the outcome of the Ripple versus SEC lawsuit. Each case is unique, and the facts and legal issues involved in the Ripple case may differ from those in the cases that the SEC has lost in the past. Nonetheless, the fact that the SEC has lost multiple cases in the Supreme Court could embolden Ripple and its legal team. It may encourage them to fight back against what they perceive as the SEC's overreach and to challenge the agency's legal positions in court. This could lead to a more aggressive defense from Ripple and a longer and more contentious legal battle. In conclusion, Stuart Alderodi's tweet about the SEC's recent record in the Supreme Court is intriguing and could have significant implications for the Ripple versus SEC lawsuit. While the outcome of past cases does not necessarily predict the outcome of the Ripple case, it could embolden Ripple and its legal team to challenge the SEC's legal positions in court. This could lead to a longer and more contentious legal battle, but it may also ultimately lead to a more just outcome. If you made it to the end of the video, thank you for being one of my best supporters, and let it be known by commenting, "Ripple will win" below. God bless you, and until next time, my friends.